We have another Netflix earnings report, and once again, for the second quarter in a row, they blew past their subscriber net additions forecast. The street was expecting around 4 million, 4 to 5 million. There's a lot of you that thought that Netflix wouldn't gain any subscribers. In fact, I ran a poll on Twitter, and 30% of you thought that Netflix would lose subscribers. Another 47% of you answered that Netflix would only gain like 2 million. Well, they just reported, and they gained 9.3 million net additions. So this is another huge blowout quarter. But Wall Street doesn't like it. In fact, the stock is selling down today because Netflix also included some news that's a little bit questionable. They said that they're no longer updating us on their quarterly subscriber numbers come next year. So the start of 2015, you're just going to go into that year if you're a Netflix shareholder, not knowing how many subscribers they have. They're not going to update you. And they're not going to update you on the average revenue per member. Those are two key metrics that investors tracked for Netflix for literally decades. It was two of the biggest key indicators for the company. And Netflix said that they're just not going to report them anymore. So the stock right now is trading like a penny stock. It's going up and down 2 or 3% every second. I'm sure it'll average out to something, but I want to look at the actual facts. What's going on with Netflix today, and how do I view this earnings report as a large shareholder of the company? Most of you are aware, but we do have continually new people to the channel, so I want to disclose again that I do own shares of Netflix. I have around a $64,000 position with around $18,000 in the green. I've owned this one since around June of 2020, so I've held it for a while. Now let's go ahead and take a look at the actual facts of what's going on with Netflix and what do we make of this earnings report. First of all, we can look at the news. The news likes to see this huge subscriber gain, right? That's what everybody's focused on with Netflix, even though the number of subscribers is increasingly becoming less important to the overall story. And there's a couple reasons for that. But regardless, if we are just focusing on subscribers, this was a big gain. They gained 16%. Now, we look at the numbers here. This is Wall Street's estimates. The earnings per share, they estimated 5.28, or that was the actual, 5.28 versus 4.52. So they crushed their earnings per share. This is why you can't always trust the analyst estimates in the PE ratio. In some cases, if a company beats its earnings, the PE ratio, which is forward-looking, was inaccurate. So Netflix really did beat their earnings per share estimate by a lot. The revenue also was a beat. 9.37 billion versus 9.28 expected. So they beat on the earnings per share, they beat on the revenue. And then in the total memberships, again, Wall Street was expecting around a 4.5 million net addition. They came in with 9.3. So they're currently at around 270 million subscribers. The scale of this company is massive. It's just massive. You look at a company like Costco and they're at 60 million. Netflix is at 270 million. All of those are monthly paying subscribers. So far this looks good, but let's go ahead and transition over to the actual earnings report. This is from the company. At the top, they always like to put the most important information, or at least what they want you to see. They say that we're off to a good start in 2024 compared to Q1 of 2023. Our revenue was up 15%. So a lot of people said that Netflix was done growing, and now it's growing mid-teens, which is a good thing to see if you're an owner of the company. Income grew by 54%, and our operating margins rose by 7 percentage points to 28%. For financial year 2024, we forecast revenue growth of 13 to 15%. So decent revenue growth from the company. We're raising our financial year 2024 operating margin forecast to 25%. So they're raising margins again. This is something that Netflix has done time and time again. They keep adjusting their forecasts higher and higher for margins. They say to sustain healthy growth long-term, we must continue to improve a variety of content on our entertainment. I think they've been doing that. You have the 3 Body Problem show, you have The Gentleman, you have all these different documentaries. I think they're coming out with better content. So I see them making changes there that I like. They also say innovating on our product and marketing. I've shown some behind the scenes things they're doing with their thumbnails, with their marketing strategy. There's a lot of stuff that people aren't paying attention to there. They say we need to tap into additional revenue and profit pools, in particular, scaling ads to become a more meaningful contributor to our business in 2025 and beyond. So a lot of these members are joining on the $7 a month plus ads tier. It's so cheap, it's hard not to have. It's difficult not to have Netflix for like $80 a year. That's like going out to eat one time with the family. So a lot of people are signing up for this ad tier. We have built a hard to replicate combination of a strong slate, superior recommendations, broad reach, and intense fandom, which drives healthy engagement on Netflix. A lot of people believe that Netflix does not have a moat, and they believe this because there's alternatives to Netflix. There's other places to watch content, so they say it must not have a moat. But they outline the moat right here. What Netflix has accomplished so far is very difficult to replicate. Other companies can't do it. They don't have the scale, they don't have the cash flows, they don't have the amount of subscribers and revenue. So I do agree with them that they've built a very difficult to replicate business at this point. Now, if we look through some of the financials here, here's where we get into the important stuff. The year-over-year revenue grew at 14.8%, so that is accelerating. The operating income was $2,633 million. What I look at more than operating income is the free cash flow. That is right here. For this quarter, just this one quarter, free cash flow is $2.1 billion. Another thing I noticed when looking at the free cash flow numbers is they report the shares outstanding. So this is the fully diluted shares outstanding, which is the one that you want to look at. And you notice how it went down again quarter over quarter. So 3 quarters ago, it was 450 million. They did buybacks down to 444, and now it's 441.7. So they're buying back more shares every single quarter, doing that with their excess cash flow. Exactly what I'd like to see. So by the numbers, it's difficult to find anything to complain about in this report. They beat on their revenue, their earnings, they printed really good free cash flow, they bought back shares, and they doubled the amount of subscribers that most people were estimating. But there is one glaring issue with this report, and it's right here. Paid membership reporting. Here we go. What is Netflix up to? As we've noted in previous letters, we're focused on revenue and operating margins as our primary financial metrics, and engagement, meaning time spent, as our best proxy for customer satisfaction. In our early days, we had little revenue and profit. Membership growth was a strong indicator for the future potential. But now that we're generating very substantial profit and free cash flow, we're also developing new revenue streams like advertising and our extra member features. So memberships are just one more component of our growth. In addition, as we've evolved our pricing and plans from a single to multiple tiers with different price points, depending on the country, each incremental paid membership has very different business impact. That's true. Some members are more valuable than others, and so they're just basically saying that. It's why we stopped providing quarterly paid membership guidance in 2023, and starting next year, here's the line right here, causing a lot of investors to question it. Starting next year with our Q1 2025 earnings, we will stop reporting quarterly membership numbers and average revenue per membership. Now they say that we'll continue to break out the revenue by region. So they're still going to give you that information, how much revenue they're making in every different region. And they also say that they're going to continue, of course, with the operating margins, free cash flow forecasts of revenue, operating income, net income, and earnings per share. They say that we'll also, and I think this is an important thing that people are missing, we'll also announce major subscriber milestones as we cross them. So they're not going to report it quarter by quarter on such a granular basis. But what they're planning on doing is, let's say that they get to 300 million or like 400 million, right? They hit some huge landmark. They'll probably say, hey, by the way, we hit 300 million or 400 million. But we're not going to update you whether it's 315 or 324 on this quarter. We're just going to give you these big milestones. So there's some investors that are going to be upset that they're no longer reporting these metrics on a quarterly basis. And a lot of critics of Netflix, you're going to hear this online, you'll see it online, they'll say that Netflix is now hiding stuff. They're not being transparent because that means they've reached the top. They're not growing anymore. What companies are already doing this type of thing? Which companies are already not giving you quarterly metric updates, but just big milestones? Apple's one. Apple only gives you their active devices when they want to. They don't give it on a quarterly basis. And Amazon's another one. Amazon does not report the amount of Prime members they have every single quarter. It's not a normal metric they give. Amazon only gives you their Prime metric once they reach big milestones. Like they'll once in a while say, hey, we just reached 300 million Prime members. And then they won't talk about it for years and years until they get to like 400 million. So you don't know on a quarterly basis how many subscribers Amazon Prime has. So this isn't a unique thing that Netflix is doing. What they're trying to do is take away focus from this metric that we're used to and instead focus on the financials of the company. the free cash flow, the revenue growth, the operating margin, and they'll give us big milestone updates along the way. Now, again, I know the gut reaction for any investor is when they're given less data about a company, it means that something shady is going on. It's like a big red flag. And that was the case with Apple. I remember in particular when Apple decided to not report their units sold anymore. They just said that they're not reporting it on a quarterly basis. They may give you some updates here and there, they may not. Here's a reaction that Kevin O'Leary had way back in 2018 to Apple saying they're not reporting their units sold.
I don't own it anymore, and I'll tell you why. Transparency. The narrative on Apple, 5 years ago I got into this stock with a story that services and software subscriptions were 2% of revenue, and that they were going to bring a whole series of innovative, what I call Trojan horses, into the market. So people would buy iPads and buy laptops and buy iPhones, and then slowly buy more and more services. That narrative was intact as the stock became the darling of pretty well every institution. And all of a sudden, out of nowhere on this print, and I mean nowhere, I'm listening to the call like everybody else, they say, we're not talking about unit sales anymore. What do you mean you're not talking about unit sales? You're a closed environment. The only way you get back into Apple on a service basis is you got to buy one of these things. And if I don't know how many you're selling, I don't know anything about you anymore. It was seconds after that I exited the stock. It's going to take a lot to get me back in. This is going to go south now because everybody's going to try and figure out, well, how do I measure?
Do they change, Kevin? Do they?
Seconds after Apple said they're no longer reporting the granular quarterly metrics of their units sold, Kevin O'Leary sold. He sold out of the stock. Apple today is up over 300% since Kevin O'Leary sold out of the stock, and that's not counting dividends. So the company has compounded 300% since then. Clearly, them not reporting the amount of units sold wasn't a huge detriment to the stock. So again, I understand if your gut reaction here is to have a degree of skepticism like Kevin O'Leary did with Apple. It's never fun when a company stops reporting something that they were previously reporting. But this is what Amazon has done with the Amazon Prime membership metric. It's what Apple's done with their units sold. When companies get mature and the metrics that they were following no longer are the best things to represent the growth of the company, they like to focus on different things. In this case, what Netflix is focusing on is the geographical revenue, which does resemble the amount of subscribers. If they have more subscribers in a region, they're going to make more revenue. So this is a change in reporting, but it doesn't change any thesis for me and Netflix. So overall, I thought this was a great quarter. Every metric that I track is going in the right direction. I realize the stock was up 90% over the trailing year, so it's hard to ask for explosive gains right now. But in terms of the fundamentals, I believe the company is headed in the right direction. But that's my thoughts on it. See you in the next one.